Hi everyone and welcome to Symax Fintech Weekly Market Insight. As usual, it's broken into 4 parts and we're going to start with a look back at the highlights of last week. As usual, we start with our disclaimer. So trading involves the potential risk of loss of capital. It's not suitable for everyone, although hopefully it is for you. When it comes to leverage, just be careful because you can lose substantially more than that initial investment. Everything we include in here is just purely for educational purposes. We're not trying to provide you with advice, we're just trying to help you prepare, understand the markets better, to help you make better decisions. But of course, if you are looking to invest or trade, that has to be your decision. And before you make that, you should consider your financial situation, your level of experience, and your risk appetite. And of course, on your risk capital, you're prepared, but more importantly, can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before risking your capital. Okay, so when we look at that, so data had sort of a mixed impact. But we saw the dollar strengthen by the end of the week. Treasury yields were back higher again, pretty much finishing unchanged for the week after they'd got weaker midweek. Gold on Monday in Asian hours made a new high all the way up to sort of pretty much 21.50. And then during the week it sort of faded a little bit, but it was still above 2000 on Friday, about 2020. And oil during the week traded below $69, closed Friday around about $71 for WTI. So that's the American crude oil. So yeah, a little bit of mixed data. This next week's going to be interesting, but I'll cover that in part 2. So okay, so when we look at the data that came out, and we start with the US as usual. So Michigan consumer sentiment was higher than expected. That came in at 69.4 on Friday. That was only expected to come in at 62. Factory orders were down 3.6%. They was expected to be down by only 2.6%. And then ADP. So ADP came in at 103,000 when it was expected to come in at 130,000. So, that was obviously lower than expected, but it was very mixed with the employment data in the US. So PMI for the US composite was 50.7. The services was 50.8. ISM PMI was 52.7, which was higher than expected. So all of them looking more positive for the US. And as I keep saying, the US does by far have the best economy. Followed closely by under the radar India, I would say. And then back onto sort of the jobs data. So JOLTS came in at 8.73 million, which again was lower than expected. And then of course Friday surprised most because NFP came in at 199,000 when it was only expected at 180. Now that's quite interesting. I did point out, and I posted on LinkedIn actually on Friday, that it could be a little bit out of line. And the reason for that was seasonal employment because of Thanksgiving, and then obviously moving on towards Christmas, so the festive season. And then on top of that, some of the strikes that have been going on, especially with the auto workers and all that, those workers were going back to work. So, they may have been included in this data. I suppose the little bit of a surprise was the unemployment rate coming back down to 3.7 from 3.9 though. And then the bits that I look at, which are the inflationary parts as well, which is the average weekly hours just crept up very, very slightly to 34.4, and the average hourly earnings crept up as well, so went up 0.4% month on month, which again, both of them were higher than expected. Okay, so moving on to the EU, retail sales were 0.1% month on month, which was lower than expected, and that means that they are negative 1.2% so far year on year. Investor confidence was lower, it came in at negative 16.8. And then some of the inflationary data, PPI came out. That was 0.2% month on month, and that's negative 9.4% year on year. So remember, that's producer prices, PPI. And then PMI, so Purchasing Managers Index, the composite came in at 47.6, which was higher than expected, as too was the services, which came in at 48.7. GDP, as expected, negative, so 0.1% quarter on quarter. That's flat for the year, and that was probably just slightly lower than what was expected. Okay, let's move on to Germany. So CPI there came in negative 0.4% month on month. That's giving 3.2% year on year. And the harmonised year on year is 2.3%. So, it's moving in the right direction still. So German trade balance was higher than expected. That came in at 17.8 billion euros. So maybe they're just sort of bottoming out with their problems with manufacturing. And then factory orders, so they were negative 3.7% month on month, which is negative 7.3% year on year. So obviously, they have struggled. And then, PMI wise, so the composite came in at 47.8 and services came in at 49.6. So, getting a bit closer towards that 50 again for the services. Where it gets into considered expansion territory, but they were both higher than expectations anyway. And industrial production was a little bit lower than expected. That came in at negative 0.4%. Okay, so moving on to the UK, retail sales came in at 2.6%, and then the PMI, so the composite was 50.7, which was higher than expected. Services came in at 50.9, higher than expected. Construction came in lower than expected though at 45.5. Okay, so let's move on now to some of the other areas. So Australia, GDP was 0.2% quarter on quarter, lower than expected. However, it was 2.1% year on year, which was higher than expected. So the PMIs again below 50, so services at 46 and the composite at 46.2, so a little bit lower than expectations there. But that did mean that RBA kept the rate, their interest rate unchanged at 4.35%. And then moving on to Switzerland, so CPI was 1.4% year on year. That was lower than expected. Their unemployment is unchanged at 2.1%, so very good there. Okay, so Japan, so the yen had some moves this week. Again, sort of a little bit more expectation from traders that they may be preparing to change policy. So CPI was 2.6% year on year and the core was 3.6% year on year. So that may have something to do with it. And also their GDP, so it was negative 0.7% quarter on quarter, which was lower than expected, and negative 2.9% year on year. Okay, so then moving on to China. Their trade balance was a surprise on the upside. So dollar-wise, it came in at 68.3 billion, when expectations were only 58.1 billion. So again, maybe that's a positive sign for them. And then we look at the Caixin PMIs. Services was 51.5, which was a beat because it was only expected 50.8. And then CPI came in at negative 0.5%, which was lower than expected month on month. And that gives a negative 0.5% year on year as well. And then PPI came in at negative 3% year on year. Again, a little bit sort of lower than expected. It was only expected to come in at negative 2.8%. But, it just sort of reflects what's going on. Inflation is starting to reduce. Again, is that just purely because of higher interest rates? For me personally, I think it's people cutting back because prices are so high now. And of course, you're still seeing that a little bit of divergence between what the producer prices are and then what the consumers are paying. There's a little bit of a distortion there because the savings from the producers and obviously the corporations that are creating the product are not necessarily passing that on to the consumer yet. Okay, and then finally, Canada, Bank of Canada left rates unchanged at 5%. Their PMIs came in at 53.2 and 54.7, which were higher than expected. Okay, so that's pretty much it for part one, where we looked back at last week. Now in part two, we're going to look at the big week we've got this coming week. So just moving on to highlight what we do as a company. Obviously, the majority of you are probably familiar with that, but there's always some new people viewing these. So it's just to give you a little bit of an insight into Symax Fintech as a company. So apart from the YouTube, we provide daily newsletters, which include sort of global headlines, global news, and then as an option, there's fresh chart levels and pivot points each day. Then when it comes to sort of workshops, if people are looking to get into trading, then our sort of introduction to trading is a great one. Trading for beginners. And then for others that are already trading but have got gaps in their knowledge or their trading skills, then we can help you with those as well. We do offer 1 week courses. They can make you feel competent and confident in just 1 week. Does it make you a trader? No, but does it give you the foundations on which to build your trading career? For sure. And if you've got that inner trader, I will find it. And of course, now you have the option of going for one of our new course, which actually includes a free trading challenge attempt as well. And then if you're really serious about making trading your career, then our comprehensive accredited masterclass is the one for you. It's designed to provide you with all the knowledge and trading tools required to navigate any market conditions, and also any asset class. And the next one of those starts on the 19th of June. So you've got a week to register if you're interested. Then trader mentoring, some people don't want to go through courses, but they do need help still, and I can certainly do that. Consulting, we consult to companies around hedging, FX and commodity exposure. And then of course we provide a mass of educational content that can be to individuals, exchanges, to brokers.
And as I just mentioned, if you're looking for that funded account, maybe you're a bit sort of undercapitalized, or possibly you just don't want to use your capital, then there's the opportunity to go through the challenge and hopefully qualify for a funded account through one of our partners, Nordic Funder. If you'd like to contact us, it's info@symaxfintech.com. Any questions you'd like to aim directly at me, it's chris.tubby@Symax Fintech. Sorry, go back to that one, Chris Tubby at symax-int.com. Just get so used to the fintech part. And of course, look forward to seeing you in the second part.